Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. And Bob, before we get into the show, Charts and Markets, your company, has a trial offer for all of their research going through to the end of this year. $60 will get you Bob's weekly Pivotal Events newsletter and editorials, along with Ross Clark's ChartWorks analysis. Now, don't forget, stock markets usually have, quote, their best 6 months at the end of the year. However, when you're going into a U.S. election, you can get some unexpected action, so they can explain some of that for you. Plus, precious metals and bonds are pulling back from their summer highs, so you can stay on top of these developments with this $60 trial subscription, and you can check out the offer at chartsandmarkets.com to sign up. Bob, our question comes all the way from Burbank, California. Can you perhaps read the question for us and answer it?
It seems that the rolling top this year failed again, just as it did in 2016. By that, he's meaning that the market has kept going up. And the major U.S. indexes have broken sharply rising uptrend wedge formations and seem to have skyrocketed since mid-October. Yet recently, on most days, there seems to be noteworthy topping tails alternating with less noteworthy bottoming tails in the major U.S. indexes. Bob, which way is the market heading into year-end? Also, some life has just come back into the precious metal sector. Is this just a short-term bull trap for the gold bugs? That's a good, thorough question, Jim. The time when insolvencies and liquidity problems can be discovered is typically in the fall. And we started earlier in the year with those problems being discovered in Turkey and in Argentina, then India, and then China. And we're fully expecting that to arrive beginning in September, and it did, because you've had the repo crisis. So you've had a liquidity crisis hit the New York financial markets, and the Fed has met that with quite a huge injection of liquidity, each one topping the other. Then that, with some news advancements on trade deals with China, has provided a pretty positive environment. So the most popular stock exchange or stock index, the S&P 500, is making new highs because institutions and central bankers around the world are buying that. The other thing is that the U.S. broad market is represented by the New York Stock Exchange Composite is not yet made new highs, nor has the World Composite Index, the one without the New York in it. It's not making new highs. So we have a massive struggle here with the biggest most liquid stocks making new highs and the rest of the market not making new highs. And with here's the other one. The other question we get on part was that with the precious metal sector. And on that one, our buy was last November. And if you look at the GDXJ, it clocked a really good rally out to July where it became overbought. And so that's where we advised taking some money off the table and thinking that another buy opportunity would be found somewhere in the winter. And the precious metals themselves, gold and silver have declined a little, and there's been a correction in the gold stocks, and I'm quite sure we can get the next entry point on these, because eventually in a post-bubble contraction, of which we're perhaps in the early stages, eventually the gold sector does very well on gold's real price advancing. So, we're looking for an entry point into the gold stocks.
We'll have more with Bob Hoye right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Bob Hoye. Bob, China has a $1 trillion bond offer or scramble going on. Can you explain what's going on there?
Oh, yeah. All of a sudden, the Chinese market, which has been iffy over the last year or so as their economy slows, but all of a sudden it's been very popular. You got to own convertible bonds. Those, of course, are corporate bonds that have a feature in them where they're convertible into equities at the bondholders' initiative. And here we are. They've got an issue coming. Orders are amounting to $1 trillion for this bond. Or there's that much going in. Anyways, the numbers are huge, and a sign of perhaps market exhaustion. Who knows? We'll see. One of the problems in a post-bubble contraction is that the bond markets, most bonds get clobbered, not because inflation comes back, but because there's so much debt offered and issued during the financial mania that there's no way that it can be serviced. So then there becomes in what I call the avoidance, revulsion of bonds and stuff like that, which is you got infatuation for a certain type of bond now. That can go away. The emerging bonds have been a favorite because they yield well. That's if they pay. And they're now become overbought a month ago and are now in a decline. So, and of course, long treasuries are in a decline in price, and junk is just beginning one. So, we could be past the best for bonds, and perhaps that headline could be maybe a tombstone. So we'll know in time.
Bob, yeah, go ahead.
Then I think there was a couple other headlines.
Yes, India industrial production falls to its lowest level in 6 years. India, at some point, we were told, was going to surpass China as an industrial giant.
Oh, yeah,
what's happening?
You were right on that. This was something that got me through the year was when earlier in the year when Argentina and Turkey, when their central banks were suddenly running out of reserves, so the currency drops and their short rates go up, which is typical of a loss of liquidity. And I'd always written on previous cycles that this was the lesser exchanges running out of the good stuff in the crisis, and then eventually it gets to the senior exchange or the world's financial capital, which is New York. And then, of course, you had India, and I was still writing that when there were reports of distress being discovered there. And then in July, China was talking about, whether it was going to lower its currency, and I thought that was policy stuff. And then all of a sudden said, no, it's part of the sequence in going from a disaster in lesser exchanges to financial problems in the senior exchange. But with China and India being so good, I had to change the term to outlying exchanges. And this is ancient, Jim, this problem. And it was described by Cicero 2,000 years ago in Rome. And he wrote clearly that when there was a financial problem, credit problem, in the eastern provinces, meaning the east end of the Mediterranean and Phoenicia and places like that, that problem, the liquidity crisis, would eventually hit the financial center in Rome. Now, that was 2,000 years ago. So here we are in New York, where suddenly the Fed has had to inject huge amounts of capital. And but the problem is that there is so much debt out there. There are so many banks in the U.S. that are outside of the Federal Reserve System, and of course the rest of the world is outside of the Federal Reserve System. So this is where you do have contractions, because the speculative play is bigger than the abilities of central bankers to keep the party going. Although this week it sort of looks like the party in New York has kept going, but you can often have a speculative spike up into late in the year, like the turn of the year. There are a number of examples going way back where a really good speculative market can peak somewhere in December or January. That was the case on the huge run-up to the highest prices for the New York Stock Exchange comp. That was in January 2018. So you have to sort of measure the buying surges for selling opportunities, and our technical work can do that. And then you also have to go the other way when things get oversold. So this thrust is impressive, and it exists, and it's getting overbought again. So we'll just watch and see how far it goes.
We'll have more with Bob Hoye right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, is there a run on the banks in Lebanon?
Yeah, that one is still going on, and that's an example of a lesser exchange, but they're losing the banks in Lebanon, which is an eastern financial focal point, and they're losing depositors. Depositors taking their money out. And, of course, this one was that the authorities are saying, oh, of course, there's no reason for there to be a run on the bank. But, hey, people, the locals there are saying, I'd sooner have cash than my money in the bank. So, and this is, again, a classic towards the end of a bubble. And there was another one I saw, Jim, that on the Austrian School of Economics is headed up by von Mises. Their observation is that at the end of a boom, the banks don't have to call in loans to force the contraction. And all they have to do is get a little nervous and stop making the loans, which is one way of looking at it. And then there was a headline I saw on that one as well, where they were stopping to lend to farmers in the U.S., that kind of thing. So it's sad to see, but we've had a fabulous bull market leveraged against an incredible expansion of credit. And you've had the players within the credit markets do their thing as well. In a boom such as we've been in, the stock market really does get most of the attention. But underneath it is the same intense speculation going on in credit spreads, which is the difference between high-grade and low-grade bonds, and then also in the yield curve, which is the difference between long bonds and T-bills. So then through the summer, the curve was doing what it does in a boom. It was flattening and heading towards inversion, where short rates get higher than long rates. And it did invert, which is a very definitive event in the credit cycle. And then now it's no longer inverted. And so Wall Streeters are saying that, oh, the warning is over. They don't understand. And we've got the yield curve back to the 1850s in the U.S. And it is very clear. You have the curve inverted, you are followed by a recession eventually. And even in 1937, 1938, the yield curve only approached inversion and didn't quite invert, but when it changed, that then signaled recession. So in that one they called the depression within the depression. So the street is reading the yield curve wrong in staying bullish. We look at the yield curve and it says, watch out for a recession. And then you have the problem of trying to service debt, and that's both personal with people with leveraged up at their brokerage accounts. You got people with huge mortgages, and you have companies hugely over in debt, and you've got municipalities that have been pushing things and have huge pension obligations. So the whole of the world is leveraged, and for a leveraged world, you have to have prices going up. And when they go down, and that means prices of stocks, bonds, and commodities, they head down, that's a sign of a contraction. And then the problem will be trying to service that immense debt, and it's not going to be a pretty picture, Jim.
And Bob, our last headline, unloved assets join the rally in the latest sign of optimism.
Yep, there you are. You've got these cross currents, and I like to pick out the positive ones because it reflects that at one part of the whole spectrum of investments, there's some hot action. And then also there was the one about $1 trillion worth of orders for convertible bonds in China. Unbelievable, but we'll monitor all of this for our readers, and we'll talk about it again.
And a reminder once again, Charts and Markets has a trial offer for all their research through to the end of the year. $60 will get you Bob's weekly Pivotal Events newsletter and also editorials and special reports from Ross Clark, and you can get them from chartsandmarkets.com. Bob, thank you so much for being on the show.
Good. Thanks a lot, Jim, and I look forward to getting together again next week.
And as Mike from Burbank found out, we do answer listener questions. So if you have a question for Bob, you can send it to info@howstreet.com. You can find us on Facebook. We're on Twitter @HowStreet, our YouTube channel, Talk Digital Network. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.